When most people start investing, they obsess over returns. They debate index funds, tech stocks, and try to squeeze out 1 or 2 extra percent. But they ignore the silent partner. The one that takes zero risk, does zero research, does zero work, and still legally claims a share of the profits. That partner is the government, and one of the biggest wealth destroyers is taxes. Not because taxes are mysterious, but because most people never design around them. If you earn a 10% return on a $1 million portfolio, you made $100,000, but in the wrong account, taxes can cut into that return before it compounds again. Over a 30-year timeline, tax drag can cost millions. Take a simple example. One investor compounds $100,000 at 8% after taxes. After 30 years, that becomes about $1,006,000. Another loses just 1% per year to tax drag and compounds at 7%. That ends near $761,000. 1 percentage point costs roughly $245,000. If the drag is 2% and the return falls to 6%, the ending value is about $574,000. Now the gap is more than $430,000. Scale that to a larger portfolio, and inefficiency can add years to your working life. The wealthy focus on 2 decisions. Asset allocation is what you buy. Asset location is where you hold it. Same investment, different tax container, very different outcome. In a few minutes, I'll show you the most common silent mistake that costs people years without them noticing and without them making a bad investment. Today, we'll decode the 3 tax buckets, the Wealth Waterfall, and how to place assets so you never pay more tax than legally required. Quick disclaimer, this is educational only, not financial advice. Regardless of where you live, most systems map to 3 buckets: taxable, tax-deferred, and tax-free. The names change by country, but the logic is similar. Governments want people to save for retirement and reduce pressure on public systems, so they create incentives. Flexibility, a tax break today, or tax-free growth for staying invested long-term. Bucket 1. Taxable. Checking, savings, and standard brokerage accounts. You're taxed when you earn income. Then, inside a taxable brokerage, you may be taxed again on dividends, bond interest, REIT income, and realized gains when you sell. Flexible, but leaky. The money is accessible, which is useful, but every taxable distribution and every realized gain can interrupt compounding. Bucket 2. Tax-deferred. In the United States, this includes traditional 401ks and traditional IRAs. The government is effectively saying, save for retirement inside this structure, and we may reduce your taxable income today. If you earn $100,000 and contribute $10,000, your taxable income may be treated more like $90,000. Inside the bucket, investments can compound without annual taxes on dividends, interest, or realized gains. Money that would have left the account can remain invested. But withdrawals are usually taxed as ordinary income later. You get a break on the seed, you pay on the harvest. This can be excellent if your tax rate today is high and your retirement tax rate is lower. Bucket 3. Tax-free. In the United States, Roth accounts. In the United Kingdom, an ISA. In Canada, a TFSA. The details vary, but the principle is powerful. Contribute money that has already been taxed, then shelter the future growth. You pay taxes up front, allow the capital to grow, and if you follow the rules, qualified withdrawals can be tax-free. This bucket is a legal vault around future compounding. As an illustration, if $50,000 grows into $5 million over decades, the goal is that the growth stays yours without annual dividend tax drag, capital gains tax, or income taxes on the way out. Same seed, different soil. The taxable account can still grow, but the plant gets clipped when it creates taxable income or gains. The tax-free vault lets the compounding engine run with fewer cuts. Over 30 years, the soil becomes part of the return. Buckets are step 1. Step 2 is order, where each paycheck should go first. The Wealth Waterfall removes emotion. You do not guess, you do not chase whatever account sounds exciting. Money flows down the steps only after the step above it has been handled. Step 1. Employer match. If your employer matches up to 5%, that is immediate free money. If you earn $80,000 and contribute 5%, you put in $4,000. If the employer matches it, another $4,000 enters the account. Before market returns, that contribution has effectively doubled. Step 2. High-interest debt purge. If debt costs more than 7%, it competes against your expected investment return. A 20% credit card balance is worse. Paying it off is like earning a guaranteed 20% return after tax, because every dollar of avoided interest is a dollar you keep. Here's the silent mistake. People fund a taxable brokerage while leaving their tax-free space unused. They may be buying a good index fund. The mistake is location. They choose the leaky bucket while the legal vault is still empty. That can cost real years over decades. Step 3. Max the tax-free bucket when eligible and appropriate. In the United States, Roth IRA limits are often around $7,000 per year, depending on age and current rules. The core idea is simple. Annual tax-free space is perishable. If you do not use that space this year, you usually cannot go back later and refill the missed room. Step 4. Fill tax-deferred space next. This can reduce current taxable income and keep more capital compounding. It is especially useful for high earners, peak earning years, or anyone expecting a lower tax bracket later. Step 5. Only then, overflow into taxable brokerage. Taxable accounts are still valuable. They are flexible, liquid, and useful for early retirement bridges, home purchases, or business opportunities. But in the waterfall, taxable comes after the strongest tax shelters are considered. Think of Jamie. She earns $6,000 per month before tax. First, 5% goes to capture the employer match, so $300 flows into her workplace plan, and her employer adds another $300. Next, she sends $500 toward a credit card balance charging 20%. Then she allocates $600 to her Roth or tax-free bucket using the annual room before it expires. After that, she increases tax-deferred contributions by another $700, lowering taxable income. If, after bills and reserves, she still has $300 left, that becomes overflow into a taxable brokerage. Every payday, the money follows the waterfall automatically. No debating, no market timing, just systems. Now, the advanced layer, asset location. Different assets create different types of returns, taxed differently. The goal is to match the asset's tax behavior with the account's protection. High-yield bonds and REITs often throw off regular income. Bond interest is typically taxed as ordinary income. REITs are income-heavy because they are designed to pass rental and property income through to shareholders instead of retaining it inside the company. That income often does not get long-term capital gains treatment. In taxable accounts, these assets can create yearly tax bills even if you never sell. That is why investors often shield them inside tax-deferred accounts. Broad equity index funds tend to be more tax efficient because they often have low turnover, meaning fewer taxable sales inside the fund. Much of the return comes from price appreciation, and appreciation is usually not taxed until you sell. Growth stocks can be tax efficient for the same reason. If a company reinvests earnings instead of paying large dividends, the investor receives more return as unrealized appreciation. No sale, no realized gain. That gives the investor control over when tax happens. Highest growth potential assets are the ones you would love to shield forever. The bigger the upside, the bigger the future tax problem can become. The tax-free bucket is strongest when it protects assets that may multiply over decades. If $10,000 becomes $100,000, the gain is $90,000. In a taxable account, selling may create a capital gains bill. In a tax-free account, if the rules are followed, the goal is that the full growth can come out without that back-end tax bill. In the late 2020s, this is not just optimization, it is defense. Returns matter, but after-tax returns are what build real wealth. We cannot control tax brackets in 2035. We cannot control future capital gains rates. We cannot control every rule change. But we can control the architecture we build today. By maximizing tax-free and tax-deferred space, using the waterfall and placing assets where they belong, you build a wall around your compounding engine. The objective is simple. Wealth should stay productive, protected, and eventually inside your family tree. Next week, we'll cover how different assets behave when inflation stays higher for longer, using historical data so you can design a system that holds up under pressure. Thanks for watching the next Decade Money. Build your system, and I'll see you next time.